I'm about to show you 3 ways to protect your options income. If you are struggling to generate consistent returns because you have huge losses that wipe out months of profits, then this is the video for you. And again, the strategies I'm going to show you have personally saved me as much as $13,000 in a single trade because I had these protections in place. Before I had these in place, I would lose as much as $15,000 on a single trade, and boy, did that hurt and crush my feelings, emotions, and my stomach turn, all that stuff. Anyways, this is the plan for the video so that you can start implementing these strategies too. First, I'm going to discuss how options income is amazing, but how it has a lot of risk and the specific types of risk we need to worry about. Number one is market crash risk. If the market crashes, we can lose it dramatically. So I'm going to show you one simple fix to solve this problem. Then I'm going to show you risk number two, which is volatility risk, and a couple tactics we can use to make a slight change to your trading strategy to fix this as well and remove that from your worries. And then last, we're going to cover manipulation risk and how it plagues the market, specifically options traders, and how we can fix that as well. So diving into the first part of this video is options income. So when we're looking at options income, what we need to understand is we have the potential to make a lot of money, which is great. Let me make my face smaller so I have more drawing space. So we have the ability to make a lot of income. The problem is if VIX spikes, we will see a lot of losses, okay? So if you don't know, as an option seller, our profit and loss is directly tied to VIX. VIX shows the risk in the market, and when we sell options, our income is based on that risk. So if VIX spikes, we're going to immediately see huge losses. And this can be bad. And again, this spike can be caused by news. This spike can be caused by a crash. This spike can be literally caused by anything, a virus, right? It can be caused by a ton of things. It's going to lead to immediate and large losses. And so if you ever had this thing where your strategy is working well and then it stops because you have one huge loss and it wipes out months of profit, it's typically from this. It's from a volatility spike where your trade's doing well, but something happens that just leads to a huge loss. And this is personally how I lost $15,000 in a single night. And so here is how we overcome it. Here is how we prevent this from happening again. So here is strategy number one, okay? We need to understand how to prevent market crash risk. If market crashes, then we are going to lose a lot of money. So how do we fix this? Number one, we can use one simple indicator that most people don't know how to properly use. And that is called the Bollinger Bands indicator. So if we're looking at it from here, this indicator can be added to any chart, whether you're using TradingView for charting or broker, whatever. Just go to indicators and type in Bollinger Bands, Bollinger bands, and you'll see it there. Now, this is what it looks like by default. And this is how most people use it, but it's incorrect. You want to go into the settings here and you want to change something that most people don't know you can change, but you go into the length, you make the length, you change it from 20, you add an extra 0 to make it 200, then click save. This shows you the average trading range, or the trading range that the market should stay in, right? So this blue highlighted area between the green line and the red line shows where the natural healthy movement for the stock is. And so if we break out to the upside, the likelihood of it pulling back is very high. We break out to the upside, pullback is high, right? And the same thing with the downside. If we break out to the downside, a push up is high. If we break out to the downside, a push up higher is very likely. And so that's how we can use it. If we're trading within this certain range, we know we're good to go. The closer we get to this red line, and especially when we break above it, this is when we know that we should be adding hedges to our position or slowly scaling out of the position. So you can see here how close we are to the red line in this area. We know we're closer. We know risk is higher. So in this point, we're actually going to start slowly closing our open positions, not putting on new ones, but maybe even using some profit to put into long puts so that when the market pulls back, or if it pulls back, we can then profit from the downside. Once it's down back in this bottom zone, we know it's a great time to get in because the likelihood of it moving higher is a lot greater. And so then we'll actually re-enter option selling positions. So the number one way to avoid market crash risk, again, first off, you won't avoid all of it. It's impossible to avoid all crashes because crashes are unpredictable. But using math and using this indicator, you can avoid a lot of them, or at least help you prepare for them. So that's how I do. Number two, again, we just covered market crash risk and how we use the Bollinger Band to fix that. But number two is volatility risk. Now, for this, I just wrote a book called Never Worry About Volatility Again, and it is on Amazon for 20 bucks. But because I love my people on YouTube, there's actually a free download down below. And if you check out that book right here, actually, there's a checklist that walks you through exactly the tactics you can use to eliminate volatility risk from your trading. That means when VIX spikes, your account is less impacted and you have less losses than another trader would because you implemented these tactics. And so these tactics look like adjusting your buying power based on VIX, using a longer DTE, using a higher probability setup, using VIX hedges, and so much more. All these tweaks can be done. If you want to learn about the specifics of it, go down below and check out this. Again, there's a chapter on every single checklist item that you can use to fully understand how to implement these things. This own video would take forever, so just click the link down below and get it for free. Anyways, let's dive into risk number three, which is manipulation risk. This one I hate, and you probably experienced, but you didn't know it, okay? So options selling and options trading is very low volume compared to the stock market. We're trading like millions of shares, tens of millions of shares a day. Options are more like in the hundreds. And so because of that, market makers can manipulate the price. And so if we think about a sniper on a rooftop, right? I'm a terrible drawer, but let's say this is a rooftop and this is a sniper trying to shoot, let's say, this person in another building through the window, right? Okay. This is a crazy scenario, but let's just pretend it, right? So if that sniper has vision of the person through the window, what can they do? They can shoot them. That's probably not the most YouTube friendly thing, whatever. You get the point. They will get destroyed if the sniper can see them. And so this is exactly what's happening in the market right now with your orders. When you put a limit order out there, whether to enter or to exit or like a stop loss or something like that, your orders are just sitting on the market for anybody to see. And these hedge funds and these market makers go out there, they see your orders, they slightly manipulate the options price to execute your trade early and resulting in a loss for you for no reason. It shouldn't have closed, it shouldn't have hit that price, and now you lose for no reason. And so that is what manipulation is. And so how do we do this? We hopefully put a screen over our window so you can't see through, or even better, just put a brick wall, right? So that the sniper can't see through the window. And this is the same thing that we do with options trading, right? We can put a brick wall between the hedge funds, the market makers, and your orders by number one, keeping the orders in-house, by AKA not submitting them into the market until you're ready to fill them, okay? So only submit a limit order when you want it to get. Do not have a stop loss just sitting out there. If it does, it will be prematurely executed. You'll lose money, and it's because they're taking advantage of you. Now, another way to fix this is to use automation because you can trigger the exits immediately when you want, which is why I created the options auto trader because I was tired of the manipulation risk. But again, these are three ways to prevent protecting your account from losses. That'd be market crash risk by assessing when the market is at its riskiest point and scaling back on that. Understanding volatility risk and sizing accordingly and using tactics like longer DTEs, lower deltas, and things like that to reduce the risk. And then manipulation risk to only submit orders into the market when you're ready to exit. If you enjoyed this video, please smash that like button, and I hope to see you in another one.